Listen to me very carefully because what I'm about to tell you could be the difference between a comfortable retirement and eating cat food in your golden years. I'm serious. We need to have a real conversation right now about something that terrifies me when I look at the data. And believe me, I look at data every single day. It's what I do. I'm Mr. Wonderful and I don't sugarcoat things when it comes to your money. Before I get into the 3 safest exchange-traded funds that every retiree should own, I need you to do something for me right now. Hit that subscribe button. Smash it. Why? Because this channel is about protecting your wealth, growing your cash flow, and making sure you never run out of money. If you're serious about your financial future, you need to be part of this community. So subscribe and turn on those notifications. The information I share here could literally save your retirement. Now let's talk about what's really happening out there. I meet people every single day, good people, hardworking individuals who have seemingly done everything right, saved money, funded their retirement accounts, and even listened to their financial advisors. Yet, they are absolutely terrified. They look at the market witnessing extreme volatility as their account balances swing up one day and down the next, leaving them unable to sleep at night. This isn't how you should be living when you're supposed to be enjoying the rewards of your hard work. The brutal truth, which almost no one wants to admit, is that most retirees are utterly unprepared for a major market crash. They believe they are ready, but their portfolios are often filled with individual stocks, overly aggressive funds for their age, or worse, they're holding too much cash, letting inflation erode their purchasing power like a relentless disease. Every single one of these common strategies is a disaster waiting to unfold. What truly keeps me awake isn't my own portfolio, that much I can assure you, but rather the thought of millions who are just one market correction away from being forced back into work at 75 years old. A profound tragedy that is entirely avoidable if you know the right approach. Let me tell you something that might surprise you. Coming from me, when you're in retirement or close to it, you simply cannot afford to be a cowboy with your money anymore. The rules of the game fundamentally change. When you're young, you have the luxury of taking risks, swinging for the fences, and putting money into growth stocks, cryptocurrencies, and all that volatile stuff. Why? Because if things go south, you have decades to recover. But in retirement, that luxury vanishes. You don't have 30 years to wait for the market to come back. You need that money now to pay your bills, maintain your lifestyle, and truly enjoy your life. This is precisely why I am utterly obsessed with safety and consistent cash flow in retirement. Notice I emphasized both safety and cash flow. You absolutely need these 2 elements working hand in hand. You can't just hide your money under a mattress and watch inflation eat it away, nor can you solely chase the highest yields without a deep understanding of the risks involved. You need a strategy that actively protects your principal investment while reliably generating income you can actually live on. And that's exactly what I'm going to show you today. The 3 exchange-traded funds I'm about to reveal to you are not glamorous or sexy. They won't promise to make you rich overnight, nor will they double your money in a mere 6 months. But here's what they will do. They will act as your unwavering shield when the market inevitably crashes. They will pay you consistent dividends, providing reliable income. And crucially, they will let you sleep soundly at night, secure in the knowledge that your retirement is protected. That kind of peace of mind, that security, is worth infinitely more than all the risky gambling in the world. Let me quickly explain why exchange-traded funds are an ideal solution for retirees. Firstly, they offer instant diversification. Instead of tying your fate to a single company that could go bankrupt tomorrow, you gain ownership in hundreds, even thousands of companies through one simple investment, spreading out your risk significantly. Secondly, they are highly liquid, meaning you can sell them on any day the market is open. Try doing that with real estate or a private business. And thirdly, their fees are remarkably low compared to traditional mutual funds. I absolutely despise high fees. Every dollar you pay in fees is a dollar that isn't working for you, isn't generating dividends, and isn't compounding your wealth. Fees are nothing short of an enemy to your financial future. However, here's where most people tragically misunderstand things. They mistakenly believe all exchange-traded funds are created equal. They are absolutely not. There are thousands of them out there, and frankly, most are complete garbage. Some are far too aggressive for a retiree's risk profile. Some are dangerously concentrated in a single narrow sector. Others burden you with exorbitant fees that will slowly bleed you dry over time. And a significant number are simply poorly constructed products designed primarily to enrich the fund company, not you. This is precisely why I dedicated months to meticulous research and analysis, specifically to identify the 3 safest, most reliable options for retirees. I scrupulously examined historical performance during multiple market crashes, scrutinizing dividend yields and their growth trajectory, comparing expense ratios, and digging deep into the underlying holdings of each fund. I left no stone unturned, because when it comes to your hard-earned retirement money, you cannot afford a single mistake. One ill-advised decision can genuinely cost you years of financial security. Before I unveil these 3 essential funds, I want to make sure you grasp a fundamentally important concept. The overarching goal here is not to get rich. If you are retired and still trying to amass a fortune, you are unequivocally playing the wrong game. The sole singular goal in retirement is to preserve your capital and generate dependable income. That's it. Some might find that boring, perhaps. But let me ask you, what's not boring? Having enough money to comfortably do whatever you desire for the rest of your life, completely free from the nagging worry of running out. That, my friends, is true freedom. That's the invaluable security we are building here today. You see, when a market crash inevitably comes, and trust me, it will come, most people will panic. They'll watch their portfolios plummet by 20%, 30%, even more, and they'll succumb to the pain, selling their holdings at the absolute bottom. That is the single worst action you can take. But with the right exchange-traded funds strategically in place, you won't need to panic, because you will know you are protected. You will know you are diversified. You will know you are still consistently receiving dividends, even as the market seems to be falling apart around you. I've personally navigated through multiple market crashes throughout my career. I've witnessed people lose absolutely everything. Conversely, I've also seen those who were incredibly smart and meticulously prepared, people who barely felt a ripple when everyone else was consumed by chaos and fear. The crucial difference between those 2 groups was strategy. It was having the foresight to put the right investments in place before the storm hit. You don't rush to buy insurance after your house has already burned down, do you? You buy it beforehand. So what are these 3 highly reliable exchange-traded funds that I implicitly trust with precious retirement money? I'm going to walk you through each one, and I want you to pay exceptionally close attention because the granular details genuinely matter here. This isn't merely about buying something because it superficially sounds appealing. You need a thorough understanding of precisely what you own and, more importantly, why you own it. The first exchange-traded fund on my meticulously curated list is a Dividend Aristocrat fund. Now you might wonder, what exactly is a Dividend Aristocrat? These are distinguished companies that have demonstrably increased their dividend payments every single year for a remarkable period of at least 25 consecutive years. Just let that sink in for a moment. 25 years of consistently raising dividends means these companies have successfully navigated and thrived through multiple recessions, countless market crashes, and numerous global crises. Yet they consistently found ways to reward their shareholders with more money, year after year after year. That, my friends, is precisely the kind of unwavering quality and rock-solid stability you absolutely need in retirement. This fund is densely populated with legendary companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble. These are foundational businesses that sell essential products people require, irrespective of broader economic conditions. People still meticulously brush their teeth during a deep recession. They continue to purchase crucial household products. They still urgently need healthcare services. These are inherently defensive businesses boasting incredible proven track records. And when you strategically own them through this particular exchange-traded fund, you effortlessly gain exposure to all of them within one wonderfully simple investment. Here's exactly why I enthusiastically champion this fund for retirees. First, the dividend yield it offers is consistently solid, typically hovering around 2.5% to 3%. That represents real, tangible cash flow you can reliably count on month after month. Second, those crucial dividends grow steadily over time, which provides a vital buffer against the relentless erosion of inflation, helping your purchasing power remain intact. Third, and this is absolutely critical, when the broader market crashes, these high-quality companies typically hold up far better than almost anything else. This resilience stems from their status as essential businesses backed by robust balance sheets. For example, during the catastrophic 2008 financial crisis and the dramatic pandemic crash, these esteemed dividend aristocrats demonstrably fell less than the overall market and perhaps even more importantly, recovered significantly faster. This predictable stability is precisely what you require when your livelihood depends on your carefully invested capital. Furthermore, the expense ratio on this fund is commendably low, generally at 0.35% or even less. This ensures that you retain a substantially larger portion of your hard-earned returns rather than channeling it into exorbitant fees paid to some fund manager who might not even outperform the market. I emphatically detest high fees. They are, in essence, a tax on your meticulously built wealth. And in retirement, you need every single dollar relentlessly working for you, not for the entrenched interests of Wall Street. Now, let's transition to the second essential exchange-traded fund, and this one is primarily focused on bonds. I understand, I know what you're thinking. Bonds often sound boring. Everyone commonly perceives bonds as investments solely for old people. Well, guess what? If you're currently retired in investing terms, you are old, and bonds are unequivocally your friend. However, we're not merely discussing just any bonds here. We're specifically focusing on a particular type of bond fund that exclusively emphasizes short-term, high-quality corporate and government bonds. Why specifically short-term? Because when prevailing interest rates fluctuate, short-term bonds do not suffer the catastrophic losses or crushing that longer-term bonds often experience. They inherently offer greater stability, significantly less volatility, and in an environment of rising interest rates, you avoid being painfully trapped holding bonds that have substantially depreciated in value. You crave flexibility, and short-term bonds deliver precisely that. Furthermore, they still consistently provide you with income. While it might not reach the lofty heights of a long-term bond's yield, the inherent safety and capital preservation are absolutely worth that modest trade-off. This bond exchange-traded fund typically holds bonds from highly reputable investment-grade companies and U.S. Treasuries, which effectively means you are lending your money to the most creditworthy borrowers on the planet. The associated risk of default is, therefore, extremely low. You won't amass a sudden fortune from this fund, but that is emphatically not its primary objective. The fundamental point is to dedicate a significant portion of your portfolio to an asset that is inherently stable, reliably generates income, and crucially, often increases in value precisely when stocks are declining. This remarkable counterbalance is the inherent beauty of strategically incorporating bonds into a diversified portfolio. They zig when stocks zag. During an inevitable market crash, this specialized bond fund functions as your powerful shock absorber. When everyone else is in a frantic panic, aggressively selling off their stocks, bonds typically appreciate in value because astute investors instinctively seek the refuge of safety. This powerful dynamic means that while your stock holdings might experience a temporary decline, your bond holdings will steadfastly hold their value or even appreciate, thereby significantly cushioning the overall blow to your total portfolio. This crucial protective mechanism is precisely why every single retiree fundamentally needs bonds in their investment strategy. It's not about being excessively conservative for conservatism's sake, it's about being profoundly smart and proactively protecting yourself from potentially catastrophic losses. The yield on this particular fund might typically range from 3% to 4%, contingent on the prevailing interest rate environment, and its expense ratio is remarkably minuscule, frequently under 0.1%. You're essentially receiving institutional-grade bond management for almost next to nothing. That represents a truly fantastic value proposition. and it is one of the primary reasons I overwhelmingly prefer these exchange-traded funds over attempting to navigate and purchase individual bonds yourself, which is typically a convoluted and costly endeavor for the vast majority of individual investors. Now we arrive at the third essential exchange-traded fund, and this one masterfully integrates all the previous concepts, truly bringing everything together into a cohesive strategy. This is a balanced fund specifically designed to hold a conservative allocation of both stocks and bonds. Envision it as a comprehensive, one-stop investment solution meticulously crafted for retirees who deeply value simplicity. You purchase this singular fund and instantly gain broad diversification across multiple critical asset classes without the burden of having to manually rebalance your portfolio or fret endlessly about achieving the correct asset mix yourself. These intelligently structured balanced funds typically maintain an allocation of approximately 40% stocks and 60% bonds, or sometimes an even 50-50 split, depending on the fund's specific mandate. The strategically included stock portion diligently works to provide you with vital growth potential and reliable dividend income, while the steadfast bond portion ensures unwavering stability and fundamental capital safety. It genuinely represents the best of both essential worlds, seamlessly encapsulated within a single convenient ticker symbol. For individuals who have no desire to meticulously scrutinize their investments daily, who simply wish to set it and forget it, this type of fund is absolutely perfect. What I find truly exceptional and immensely beneficial about these particular balanced funds is their integrated feature of automatic rebalancing. When stocks experience significant gains, the fund managers intelligently sell a portion of the appreciated stocks and subsequently purchase more bonds, effectively bringing the portfolio back to its target asset allocation. Conversely, when the stock market suffers a decline or crashes, the fund performs the opposite maneuver. It systematically buys stocks at more favorable, cheaper prices, leveraging its existing bond holdings. This intelligent, automated process essentially compels you to buy low and sell high, which is precisely the optimal investment strategy, but one that most individuals struggle with due to their emotional impulses. The fund executes this without human intervention, thereby effectively eliminating common human errors and emotional pitfalls from the investment equation. The returns generated by these balanced funds are not designed to be astronomically high or blow your mind, but they are remarkably consistent and predictably stable, which is an invaluable characteristic you unequivocally need during your retirement years. Over extended periods, you can reasonably anticipate average annual returns in the range of 5% to 7%, but critically, this comes with significantly lower volatility compared to a portfolio composed solely of stocks. And most importantly, when the market experiences inevitable downturns, these meticulously constructed funds do not disintegrate. They might, for example, experience a moderate drop of 10% or 15% instead of a devastating 30% or 40%, which empowers you to remain calm and steadfastly adhere to your meticulously crafted plan, rather than succumbing to panic and making profoundly detrimental decisions. The expense ratios associated with these balanced funds are also exceptionally low, typically remaining under 0.2%. You are effectively gaining professional-grade asset allocation management and automated rebalancing for virtually no cost. Compare that astounding value to the standard practice of paying a traditional financial advisor 1% of your entire assets every single year, and you can clearly comprehend precisely why I have such a profound appreciation for these highly efficient funds. You are strategically saving thousands of dollars in fees annually while simultaneously achieving comparable or even superior investment outcomes. Now, here is the overarching strategy I recommend for the vast majority of retirees, and this is absolutely critical, so please listen with utmost care. You absolutely do not have to pick just one of these outstanding funds. In fact, you probably shouldn't limit yourself. The unequivocally smart approach is to judiciously use all three together in a harmonious combination that perfectly aligns with your individual personal risk tolerance and specific income requirements. If you find yourself in need of a substantial amount of current income to cover your living expenses, you might logically allocate a greater portion of your capital to the Dividend Aristocrat Fund and the Bond Fund. Conversely, if your personal financial situation allows you to comfortably shoulder a little more risk in pursuit of long-term growth, you could strategically increase your allocation to the Balanced Fund. The fundamental key here is to meticulously construct a diversified portfolio that genuinely allows you to sleep peacefully through the night, entirely free from financial anxiety. I have personally witnessed far too many retirees who were unwisely persuaded into aggressively structured portfolios by overly optimistic advisors, promising unrealistic returns, only to watch in horror as the market subsequently plunged. Unable to withstand the emotional and financial pain, they unfortunately sold their holdings at the absolute worst possible moment, thereby locking in massive, often irreversible losses from which they could never fully recover. That, my friends, is an unmitigated tragedy, and it is entirely avoidable if you meticulously build your retirement portfolio the right way, precisely from the very beginning. Consider it this way. If you have diligently saved a comfortable sum of $1 million for your retirement, you might intelligently allocate $300,000 into the Dividend Aristocrat Fund, dedicate another $300,000 to the Secure Bond Fund, and wisely place the remaining $400,000 into the Diversified Balanced Fund. This thoughtful allocation immediately grants you robust diversification across distinctly different investment strategies and multiple essential asset classes. You're securing reliable income streams from dividends, unwavering safety and principal protection from bonds, and measured growth potential from the expertly managed balanced mix. When one particular segment of your carefully constructed portfolio experiences a temporary dip, another segment is highly likely to be either holding steadfast or even appreciating in value. And that truly is the profound beauty inherent in this holistic, multifaceted approach. You are not recklessly placing all your precious eggs into a single vulnerable basket. You are not solely relying on one isolated strategy or a single volatile asset class to successfully navigate you through your entire retirement journey. Instead, you have meticulously constructed an impregnable financial fortress around your hard-earned money. And when the inevitable economic storms roll in, and trust me, they absolutely will come, you are going to emerge completely fine, remarkably unscathed, while everyone else around you is frantically running around, engulfed in financial panic. Let me unequivocally tell you what happens when you negligently fail to establish this vital protection. I've personally witnessed this distressing scenario unfold repeatedly, time and time again. The market surges, everything seems to be going spectacularly well, and people begin to feel overly confident, perhaps even outright cocky. They genuinely believe they are investment geniuses simply because their portfolio coincidentally gained 20% last year. Then, with devastating abruptness, a market crash hits. Perhaps it's another financial crisis of monumental proportions. Perhaps it's an unprecedented global pandemic. Or perhaps it's some entirely unforeseen black swan event that none of us can predict in the current moment. Suddenly, their carefully accumulated portfolio plummets by a staggering 30%, 40%, or even a catastrophic 50%. And because they urgently need that money to sustain their very lives, they are cruelly forced into the excruciating position of selling their investments at the absolute nadir, the worst possible time, merely to cover their essential bills. That, my friends, is what I unequivocally call a death spiral. Once you initiate the process of selling your investments amidst a market crash, you are irretrievably locking in losses that can never, ever be recouped. And here's the truly insidious, agonizing part. When the market eventually and inevitably recovers, which it always has and always will, you are completely unable to participate in that critical rebound because you have already liquidated your positions. You capitulated and got out at the very bottom. And now you are left helplessly sitting in cash, watching in frustrated disbelief as everyone else subsequently makes money while you are agonizingly attempting to devise a way to make your rapidly diminishing remaining savings miraculously last another 20 difficult years. It is an absolute nightmare scenario, and it is 100% completely preventable. This then is precisely why the 3 highly effective exchange-traded funds I've just meticulously described to you are so extraordinarily critical. They are masterfully designed to prevent that nightmarish scenario from ever even beginning to happen to you. The Dividend Aristocrat Fund will unfailingly continue to pay you its consistent dividends, even when stock prices are precipitously falling around you. The bond fund will reliably provide steadfast stability and will often, quite counterintuitively, increase in value when the stock market experiences a brutal crash. And the balanced fund will brilliantly and automatically rebalance itself to strategically capitalize on market volatility, all without you having to lift a single finger. United in a synergistic combination, these funds create an investment portfolio that possesses the innate resilience to weather absolutely any financial storm the market might unleash. But here's an uncomfortable truth you must deeply comprehend about market crashes. They are not exceedingly rare events that only occur once in a lifetime. They are in fact regular and recurrent occurrences within the natural economic cycle. If you are preparing to be retired for a substantial period of 20 or even 30 years, you are unequivocally going to live through multiple significant market crashes. That is simply an undeniable, immutable fact. The critical question, therefore, is not if they will happen, but are you going to be thoroughly prepared for them? Or are you unfortunately going to be a helpless victim of their devastating impact? The crucial choice, my friends, is unequivocally yours, but you must make that critical decision now, decisively, before the inevitable next crash suddenly engulfs us all. I want to discuss a vitally important aspect that tragically doesn't receive nearly enough attention: the intricate psychology of retirement investing. This is fundamentally where the vast majority of people utterly fail. Not primarily because they chose inherently bad investments, but because they simply couldn't withstand the intense emotional roller coaster that inevitably accompanies market fluctuations. When you are actively employed and diligently contributing money into your retirement account every single month, a market crash can, in an ironic twist, actually be a highly beneficial event, as you are then able to purchase more valuable shares at significantly lower prices. However, when you are retired and systematically withdrawing money to fund your daily lifestyle, a crash feels profoundly terrifying because you are actively watching your meticulously built nest egg shrink dramatically while you are simultaneously still forced to spend from it. This acute phenomenon is widely referred to as sequence of returns risk, and it unequivocally represents one of the single greatest dangers that retirees universally face. If you retire just prior to a major market crash and are subsequently compelled to sell off your cherished shares at drastically depressed prices merely to sustain your chosen lifestyle, you can permanently and irreparably damage your portfolio's long-term ability to adequately last. However, if you possess the strategically correct mix of diverse assets, if you have those vital bonds and dependable dividend-paying funds, steadfastly providing both unwavering stability and consistent income, you are then not forced into the calamitous position of selling your core stocks at the market's absolute bottom. Instead, you can comfortably live off the inherently safer segments of your resilient portfolio and patiently allow the equity-based stock portion to fully recover at its own pace. That, my friends, is the entire game-changing strategy right there. Let me illustrate this with a concrete, real-world example. During the catastrophic financial crisis of 2008, the stock market plummeted by approximately 50% from its peak value to its deepest trough. If you had unadvisedly held all your retirement money solely in stocks and desperately needed to withdraw $50,000 annually to cover your living expenses, you would have been compelled to sell twice as many shares to generate that necessary cash compared to before the market crash. That situation is unequivocally devastating and can be financially crippling. However, if you had judiciously constructed a resilient portfolio, much like the one I'm describing, complete with strategic allocations to bonds and reliable dividend funds, you could have comfortably withdrawn that essential $50,000 from those inherently stable sources and never once had to touch your critically important stock holdings. A few years later, when the stock market invariably recovered, your portfolio would have remained in an excellent, robust financial state, rather than being permanently ravaged and crippled by those earlier forced sales. This is precisely why I am so incredibly passionate about this particular investment strategy. It is not merely a theoretical concept, it undeniably works. I have personally observed its protective efficacy through multiple devastating market crashes. I have witnessed it unequivocally safeguard people's hard-earned retirements, while their neighbors, who had opted for overly aggressive, unprotected portfolios, were utterly destroyed financially. The profound difference between ultimate success and crushing failure in retirement frequently boils down to how expertly and resiliently you navigate these inevitable market crashes. And the single most effective way to skillfully handle them is to meticulously build a portfolio that never, under any circumstances, forces you to make terrible, emotion-driven decisions under extreme pressure. Now, I want to squarely address a pertinent concern that I know some of you are currently contemplating. You're likely thinking, Kevin, these funds certainly sound safe and stable, but what about the potential for growth? What if I'm fortunate enough to live until 95? Won't I risk running out of money if I'm playing it excessively safe? This is an exceptionally good and highly relevant question, and here is my definitive answer. First and foremost, let me assure you, these recommended funds do provide inherent growth. The carefully selected dividend aristocrats consistently grow their dividend payments over time, which directly translates into an increasing stream of income for you. The balanced fund inherently incorporates significant stock market exposure, which historically appreciates and grows over long periods. You are emphatically not sacrificing all potential growth at the altar of safety. Rather, you are deliberately striking the optimal healthy balance between these two vital objectives. Second, the crucial concern of running out of money is not exclusively dictated by how much your portfolio manages to grow. It is equally, if not more, influenced by how prudently you manage your spending habits and, most critically, how expertly you navigate market volatility. If you possess an aggressively positioned portfolio that suddenly crashes, and you then panic and liquidate your assets, you will undoubtedly run out of money significantly faster than someone with a strategically conservative, resilient portfolio, who calmly stays the course and steadfastly adheres to their well-defined plan. Your behavior, your reactions to market fluctuations, profoundly matters more than merely raw investment returns in retirement. I cannot stress this singular point enough. Third, remember you always retain the flexibility to adjust your strategy as your circumstances evolve. If, for instance, you find yourself at 70 years old with your portfolio performing exceptionally well and you consciously decide to embrace a slightly higher degree of risk, you absolutely can strategically reallocate a portion of your funds into more growth-oriented investments. However, you make such critical decisions from a powerful position of strength and careful deliberation, not from a reactive state of desperation. You execute calculated, informed decisions based on your current personal situation and long-term objectives, not irrational, emotion-fueled decisions driven by either fear or excessive greed. That, my friends, is precisely how genuinely wealthy individuals intelligently approach their money, and that is precisely the mindset you must cultivate. Here is yet another crucial truth I want you to forever ingrain in your memory. The ultimate objective of retirement is emphatically not to die having accumulated the most money possible. The profound objective is to genuinely live the life you aspire to, comfortably and without anxiety, never once having to worry about ultimately running out of money. That might initially sound deceptively obvious, yet you would be utterly astonished by how many individuals tragically overlook this fundamental truth. They become so entirely obsessed with the incessant growth of their portfolio that they ironically fail to actually savor and truly enjoy their well-deserved retirement years. They live in constant apprehension, terrified to spend anything, perpetually paralyzed by anxieties about an uncertain financial future. That is unequivocally no way to truly live one's golden years. With the correct protective portfolio diligently in place, with these 3 robust exchange-traded funds diligently working in powerful synergy, you can spend your money with genuine confidence and peace of mind. You inherently know you have a stable, predictable income stream consistently flowing in. You are inherently aware that you are diligently protected against devastating market crashes. You fundamentally understand that your hard-earned money is robustly engineered to last throughout your entire lifespan. That profound level of financial confidence is truly priceless. It generously empowers you to actually immerse yourself in and relish your retirement, instead of spending every waking day anxiously scrutinizing your account balance and incessantly worrying about every single market fluctuation. Let me clearly articulate what you need to decisively do right now. If you are not already strategically invested in funds akin to these, you absolutely need to implement a significant change immediately. I genuinely don't care if it means you have to divest some individual stocks or judiciously extricate yourself from certain overly risky investments. Your precious retirement is far too significant, far too invaluable to gamble away. Open a brokerage account without delay if you don't yet possess one, and decisively commence the process of building this fundamental portfolio. You are perfectly capable of executing this yourself in approximately 20 minutes. It is emphatically not a complex undertaking. You are merely acquiring 3 distinct funds. That is unequivocally all there is to it. And here's the truly magnificent part. Once you meticulously set this powerful system up, you will barely, if ever, need to touch it again. Perhaps once a year, you might engage in a minor rebalancing effort if your asset allocations have inadvertently drifted slightly out of alignment. Perhaps you might opt to reinvest your generated dividends, or you might choose to receive them as immediate cash, depending entirely on your prevailing financial needs. But for the vast majority of the time, you simply set it and then you forget it. You are not actively engaged in risky day trading. You are not perpetually watching every single news broadcast, consumed by panic over daily market movements. You have meticulously constructed a highly efficient financial machine that reliably generates income and steadfastly protects your accumulated wealth. And now you simply permit it to diligently operate. This, my friends, is the unequivocal hallmark of smart money management. This is precisely how you not only survive, but also thrive through severe market crashes. This is how you unequivocally ensure that you never ever have to return to a grueling job at 75 years old. And this is profoundly how you deliberately cultivate the capacity to leave a meaningful legacy behind for your cherished children or a worthy charity when you are ultimately gone. It all profoundly commences with establishing the correct, robust financial foundation. And that absolutely vital foundation is meticulously constructed upon the 3 pillars of unwavering safety, intelligent diversification, and consistent, reliable cash flow. Before we conclusively wrap up this crucial discussion, I urgently need you to undertake something fundamental for me. If this presentation has provided you with genuine insight, if you have genuinely gleaned something profoundly valuable, I implore you to hit that like button right now. It is a simple action that significantly aids in ensuring other individuals discover this vitally important information, and more people desperately need to hear this urgent message. Far too many retirees are currently making egregious mistakes that will ultimately cost them absolutely everything, and we unequivocally need to disseminate this critical warning far and wide. And if, for some perplexing reason, you haven't yet subscribed, what, pray tell, are you possibly waiting for? This channel is entirely dedicated to steadfastly protecting your wealth and empowering you to make extraordinarily smart, astute money decisions. I am consistently releasing valuable content that possesses the inherent potential to profoundly transform your entire financial life. So subscribe now, enthusiastically hit that bell icon so you receive timely notifications and become an integral part of this invaluable community. We are collectively constructing something truly special and impactful here, and I earnestly want you to be a foundational part of it. Furthermore, please take a moment to leave me a thoughtful comment below and tell me, are you contemplating implementing this precisely outlined strategy? Do you already wisely own funds of this specific caliber? What fundamentally is your single biggest apprehension or fear regarding your retirement? I meticulously read every single comment, and I genuinely relish hearing directly from each of you. This is the very essence of how we collaboratively learn from each other's experiences and collectively become more proficient stewards of our hard-earned money. And the 3 exceptional exchange-traded funds I have just meticulously shared with you constitute the fundamental, unshakable bedrock upon which the realization of that incredible future is built. They are not designed to be exciting in a conventional sense. They are certainly not going to miraculously transform you into an overnight millionaire. But what they unequivocally will do is protect you with steadfast reliability precisely when that protection matters the absolute most. Remember this enduring axiom: in retirement, the objective is not to relentlessly hit towering home runs. The paramount objective is to strategically avoid striking out. It is about resolutely staying in the financial game long enough to undeniably win. And with these diligently selected funds firmly ensconced in your diversified portfolio, you are going to undeniably stay in that crucial game, resiliently enduring no matter what unexpected challenges the turbulent market capriciously throws at you. That, my friends, is an unwavering promise. That is Mr. Wonderful's personal guarantee to you. Now get out there and decisively take complete control of your financial future. Meticulously build that protective portfolio, safeguard your invaluable retirement, and embrace the life of freedom and comfort that you so unequivocally deserve. Thank you for watching, and I'll be eagerly anticipating seeing you in the next presentation.